Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be talking about Bill Gates' top 5 dividend stocks. If you guys do enjoy these types of videos, make sure to subscribe to the channel, and as always, we'll begin by taking a look at my portfolio dashboard. So this week, I'm actually down a little bit on my total return, down to 28.34% because there has been a bit of a swing down in a lot of my holdings. Of course, that is still terrific performance, and I won't be surprised if we do have a correction, so it's not too big of a deal for me. Regarding my dividend performance, I did recently receive a very tiny dividend that pushed me over the $900 mark. I'm now sitting at $900.12 of total dividend earned. This of course does not include any money in my money market funds, just the dividends from my stocks. The next goal I do have to hit is $1,000, and hopefully I'll be able to hit that in the next 1 to 2 months. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. And coming in at Bill Gates' #1 largest holding, we have Microsoft Corporation. Of course, Bill Gates is one of the co-founders of Microsoft, and it makes up 34% of his total portfolio value, which is an insane amount. The most recent activity relating to Microsoft, we can see in his portfolio, is a reduction of 2.74%, but he still does hold 38 million shares with a reported price of $376. That puts his total value at over $14 billion worth of Microsoft stock, and that is absolutely absurd. So I do personally hold Microsoft in my own portfolio as well. I paid an average price of $231 per share. This was almost 2 years ago now, and at the current price of $425 per share, I'm actually up over $797, which is a percent change of 86%, which is amazing. My current position is only worth about $1,700, so my allocation is sitting at right around 4.7%, which is not crazy, but it's still pretty solid for me. I would love to get this a little bit higher than that. My yield on cost is 1.27%, and the current yield is much lower than that thanks to that price appreciation that we have seen this year. Moving into Seeking Alpha, we can see that Microsoft has enjoyed a very good bull run in 2023 and moving into as well early 2024, up almost 50%. Now, as you guys saw in my portfolio, it is actually my best performing holding right now in my portfolio in general, so I'm very happy to be holding it, and I definitely look to continue holding it in the near future. Both their 5 and 10-year performance is really strong, and ever since they went to a subscription-based model for their services, they definitely have been earning a lot more money than they did before. Now, with their current PE ratio of 36, this company does look a little bit overvalued, but that'll just depend on their future growth as well as the growth from the AI sector in general, because they definitely have been riding those highs from that. Taking a look at their financial performance, we can see that their revenues are up very drastically in these past couple years, and the same can be said for both their gross profits and of course their earnings per share. As expected, both their R&D and operating expenses have increased very quickly over time, but their revenue and revenue growth has been much faster than that, so it doesn't technically matter that much. Now, one thing that I do really like to see, and you can see it better on the numbers in the graph itself, but that the shares outstanding have been going down over time, and that's because of their aggressive share buyback program. Overall, this is a good thing because it does increase the ownership of the company, and hopefully they continue doing this into the coming years more aggressively over time. And even though we have seen a very sharp increase in their dividend over time, their payout ratio has actually decreased, which is fantastic, and it's something you want to see in a strong company. You definitely don't want it to go too high because that could mean an unsafe dividend. Taking a look at their cash flows, we can see that their free cash flow per share has increased aggressively over time. 2022 is when it last peaked, but 2023 is just as strong, still sitting significantly over what it was in 2021. These kinds of metrics are important to look at because it definitely helps understand where their dividend is coming from and how safe their dividend is for the future, as well as their future growth prospects and their ability to invest back into their own company. Now, in terms of dividend, their forward dividend yield does sit at a low 0.71%, and their pay ratio sits at a very comfortable 25.86%. Their 5-year growth rate is double digits, sitting at 10.2%, and they've shown no signs of slowing down soon, so I'm really happy with this holding of mine. I definitely wish I would have bought more of this company. Their current dividend growth history of 19 consecutive years of growing that dividend is amazing, and with that track record, I'm sure they'll be hitting Dividend Aristocrat status in no time. Now, I know what a lot of you guys are thinking. 0.67% dividend yield is very, very low. How's that ever going to help me? How's that going to snowball? Well, if we look at their yield on cost, you can see here that tells a completely different story. Basically, if you would have bought the company 10 years ago, your yield on cost would be significantly higher than the current dividend yield. So if we take a look 10 years ago, you would have been sitting at a 7.65% dividend yield on cost. That's because the current dividend compared to the price you paid for it is much higher than the current dividend compared to the price that it is right now. Now, the longer you do hold these dividend growth stocks, assuming they continue to grow their dividend, the higher yield on cost will be, unless the price, of course, shoots back down. Looking at their expected growth, we can see that they had a 11.5% year-over-year revenue growth, and their expected forward-looking growth is about 12%, which is very strong. Now, if they are able to hit these numbers, I do think we can see that 36 PE ratio being justified, but if the earnings do falter just a little bit, or if their guidance is weakened, I definitely think we could see a correction in the stock price. Microsoft is a very profitable company, as a lot are in the software space. Of course, not as profitable as a company like Visa or MasterCard, but it's still very good margins to be dealing with, and I think it'll continue being a very good success story for them going forward. The second biggest holding within this portfolio is Berkshire Hathaway, ticker symbol BRK. Now, this isn't technically a dividend stock, so I'm not going to be talking about it too much today. I just wanted to mention it kind of like an honorable mention because within that company, they hold a lot of different dividend paying stocks such as Apple and Coca-Cola. Currently, it does make up a total of 16.8% of his portfolio, and he has reduced it by 11.6%, presumably because of the Apple position having such strong gains lately. He owns a total of just under 20 million shares of this company at a reported price of $356, which gives it a total value of $7 billion. His second largest dividend holding is actually Canadian National Railway Company, making up an impressive 16.29% of his portfolio, so right behind Berkshire Hathaway. He owns right under 55 million shares of this company with a reported price of $125. That gives his reported value at right under $7 billion, which is an outstanding position to be in. Now, personally, I don't hold any stock in Canadian National Railway Company, but I do have a position in Union Pacific, though it is very small, so we'll take a look at that right now. So my Union Pacific position is actually only one share. I bought it at $191, and I've seen a great price appreciation all the way up to $242, so it would have been nice if I had purchased some more at that time. My total gain is sitting at $55, or a 29% increase in value, and my dividend earned so far has been $5.25, and I continue to earn a good dividend per year on this position. Now, I think this company does have a couple problems, a lot of it relating to its margins business and also its growth prospects. So I am looking to sell this position soon. I do think I haven't decided just yet, but I'm definitely leaning towards selling it just because it's such a small position in my portfolio. Now, if we take a look right here, we can see that it's about 0.7% of my portfolio, which is not substantial enough to keep it in my opinion. I could buy more shares and raise it to about 2% of my portfolio, but I just think that these prices I'd just rather sell and buy into other holdings. Now, contrary to Microsoft, Canadian National Railway has had more modest performance. In the past 1 year, they're up 10.8%. In the past 5 years, they're up 44%. In the past 10 years, they're up 136%. These are very respectable growth rates, especially with their 1.83% dividend yield, but it's nothing to write home about. Now, taking a look at their financials, we can see that they've been able to increase their revenue over time, but it has been much slower rate than other companies like Microsoft, and it actually hasn't been consistently going upwards this whole time. Now, their total operating expenses over time have increased, and it seems like they've been increasing faster than their revenue over time, which is not something that we do like to see. Now, it is definitely something that does concern me about railroad companies. The amount of capital that has to be invested into the company in order to be successful is a very large amount. In order to stay competitive, you have to keep acquiring either other companies or, of course, building railroads in new areas. Now, the trains being used aren't cheap either, and any sort of problems within the trains or the railroad can be very expensive for the company to deal with. Now, something that is fantastic is their shares over time. We can see that the shares outstanding have been decreasing actually very quickly, potentially even at a faster rate than Microsoft, which is something that's really great to see. Their free cash flow per share is not bad. It was very low in 2019, but since then it has basically doubled, sitting at $4.34 per share in 2023. Now, I do still feel that companies like this have a lot of room for price appreciation, but a lot of that does come from expanding their margins. Now, the already low margins do hinder the growth prospects of this type of industry, but if they are able to expand their margins, they could definitely see some nice price appreciation going forward. Their dividend yield currently sits at 1.83%, their pay ratio is at 44%, a little higher than what I would like, but still comfortably under 50%, and their 5-year growth rate is at double digits at 10.58%, which is amazing. Now, one thing that is important to consider, and we'll take a look at in a second, is their dividend growth history, which is only at a measly 2 years. Now, as you can see, they do have pretty consistent dividend growth, but in 2020, we can see that they did miss a dividend payment, which is something that's not great to see. I know a lot of companies miss dividend payments during this time, and other companies just actually use this as an excuse in order to not pay their dividend, but going forward, they have reinstated it back at the same values and continue to grow it as they can. Looking at their all-time dividend growth history, they have been pretty consistent about growing their dividends over time. So I think unless there's pretty big upsets in their business, they're probably going to continue growing it for the foreseeable future. Now, based on Seeking Alpha, their revenue growth does not look great. Past year, they were down 1.63%, and going forward, they are looking to increase it by 2.63%, which is very low, especially compared to the sector median. Now, for a railroad company, their profit margins are pretty solid, sitting at 56.14% gross profit margin, and compared to the sector median, which is at 30%, that's pretty good. And moving down to his third largest dividend holding, it's Waste Management, sitting at 15% of his portfolio. Now, this company is definitely a fan favorite of many dividend investors, and he owns 35 million shares of it with a reported price of $179, giving him a total value of $6.3 billion. I think this is a fantastic holding that's going to continue giving consistent returns to its shareholders in both dividends and price appreciation. Now, personally, I don't hold any Waste Management because it just never dipped down to the prices that I was looking to buy it at. And in 2023, it was very close when it was dipping down towards $150 per share, but it just wasn't quite cheap enough for my liking. Now, if we take a look at Waste Management, ticker symbol WM, we can see in the past year they're up 27%, and where a lot of people bought was actually October when it was down almost at $150 per share. Since then, there's been very nice price appreciation for anybody who purchased some stock during that time. In the past 5 years, they're up a very strong 102%. In the past 10 years, they're up 403%, and that's not actually including the dividend yield itself. Over time, Waste Management has proven itself to be a very strong business with its current revenue sitting way higher than in 2019. As we do always like to see, their shares outstanding have decreased over time, not too significantly, but it's very consistent. I do think they're going to increase that rate in the future. Now, their dividend payout ratio is sitting very nicely under 50%, and the only time I'd be concerned was in 2020 when it started creeping up towards 62%, but that was to be expected. Since then, they've not only increased their dividend multiple times, but they've also reduced their payout ratio, which is something that's amazing to see in a company. Shows how strong they are. And the one graph here that's a little wonky is their free cash flow per share. We can see that in 2019, it was sitting at almost $5 per share. 2020 was actually lower, and 2021 was its last peak. So 2023 is not sitting as nicely as before, but I do think that's because of investments back into the company and probably even some debt that they've had to issue. Taking a look at their dividend payout history, we can see that they have a very long history of increasing those dividends, and some of these increases are pretty substantial over double-digit growth. Now, I do believe that the most recent increase was at 7.6%, which is not bad at all, and is definitely a competitive growth rate, especially in this market. Their future revenue growth is on the lower side at 5.5%, but still substantially higher than CNI, so it's definitely a company that I prefer holding over Canadian National Railway. Their gross profit margins are lower just because of how capital intensive this business is as well, but compared to the sector median, they're actually doing pretty good at 38.28%. Now, Bill Gates' fourth largest dividend holding is Caterpillar, or CAT as a lot of you may know it. They make excavators and other industrial machinery, and it makes up 5.14% of his portfolio. I'm a big fan of his holding in this, and if you guys have seen their recent performance, this company is up big time this past year. With 7 million shares at a reported price of $295 per share, his value is sitting at over $2 billion in this company, and I think it's a great investment for both the short term and long term. Now, Caterpillar is a company that I personally love, and I've been wanting to jump into this position at multiple different times, but every time I've hesitated and every time I've regretted it. So I think sooner or later I will just have to, bite the bullet and just buy it. They had a pretty substantial dip all the way up to early November, which a lot of different companies had, and since then it's basically skyrocketed up the price. In the past year, they are up 77.63%. In the past 5 years, they're up 170%, which is way stronger than the market. Now, their 10-year growth rate sits at a phenomenal 275%, and that doesn't even include dividends being reinvested back into the company. And like I mentioned before, Cat and John Deere are a little bit more cyclical, so you can see how it goes up and the price goes back down again and goes up and then has a period of decline. So this company usually has more opportunities to buy if you are looking to jump into a position. Overall, their financials do look similar to companies such as Microsoft, with a higher spike in 2019, but in 2023 we've caught back up and increased that even more significantly than before. As we'd expect with any good quality company, their basic shares outstanding have actually gone down over time, and they're going to continue doing share buybacks in order to keep this rate increasing. Their payout ratio is very low, almost the same as Microsoft, sitting under 25%, and the only one that would concern me is December of 2020, but that was during COVID times. You can give them some slack on that because they've had it under control since then. And lastly, we can look at their free cash flow per share. It does look very strong. In 2019, sitting at $7.56 per share. Fast forward to 2023, they're sitting at almost $20 per share, which is insane. Now, CAT is a dividend aristocrat, sitting at over 30 years of consecutive dividend growth with a 5-year growth rate of 8.7%, which is pretty solid, and a pay ratio of 24%. I think they're going to continue growing this dividend for many more years to come. Now, what I would like to see from them is more double-digit increases in their dividend yield. I would love to see that number closer to 10%, but that is still fantastic even at 8.7% right now. Now, their growth metrics are all over the place, and their forward-looking revenue growth is at 5.4%, which is substantially lower than their past year-over-year revenue growth at 12.84%, but that could be expected. In terms of gross profit margins, their margins are actually smaller than a lot of the other businesses we have taken a look at, and that's something I would like to see them increase over time. And the fifth and final dividend stock that Bill Gates owns that we are going to be talking about today is Deere & Co., ticker symbol DE, and you guys might know them as John Deere. Now, this company is very similar to Caterpillar in function, but what they do focus on more is industrial farm equipment. He's recently reduced his holding in this company by 9.2%, so it now makes 3.36% of his portfolio. At 3.5 million shares at $400 per share, he owns about $1.4 billion with this company. Now, this is an extremely strong company, as we'll see in a little bit. They have amazing dividend performance, especially this past year where they raised it, I believe, 2 or 3 times in 2023. Now, the only thing that you should note with John Deere and Caterpillar is that they do have big swings both up and down since they're very cyclical companies. Deere & Company has had a decent year this past year, up 10.36%. The company is cyclical in nature, so they have had a decent amount of buying opportunities to buy into the company at lower prices, both in May of 2023 as well as December of 2023. Even more recently, we did see a pretty strong dip in February, and it's since recovered pretty nicely. In the past 5 years, they are up 150%. Most of that growth actually came after the COVID drop, where they increased very quickly up until mid-2021. Their 10-year growth rate is strong, and anybody who's holding this company for a long time is actually sitting very nicely. Similar to the other companies we've seen today, aside from the 2019 to 2020 dip, this company has increased its revenues very aggressively over time. They have been buying back their shares at a pretty quick rate, and their payout ratio is very low, under 15% of their total free cash flow. Their dividend scorecard is a little weird, sitting at 1.43%. Their pay ratio is at 15%. Their 5-year growth rate is over double digits at 13.82%. And their dividend growth history is only at 3 years, which is kind of the odd part to me. This company is definitely focused on growing its dividends in 2023, but before that, we can see that it has had some spotty history. Now, basically, John Deere has had pretty long years of stagnant dividend growth from 2015 all the way to 2018. Basically, it didn't grow, and the same thing can be said from 2018 all the way up to 2021. So it's kind of a pattern that I've seen within this company. Then from 2021 to 2024, they actually have been increasing it more consistently, and if we put it into a 3-year time frame, we can see that it increased it on multiple quarters in 2023. Their year-over-year revenue growth is actually lower than CAT's at 9.18%, and their revenue growth looking forward is actually negative, which is not too great to see. Now, of course, a lot of this expectation is already priced into the stock, so it doesn't mean that you shouldn't buy the company just because of this information. In terms of profitability, we can see a similar image to what we saw with Caterpillar at 34% for their gross profit margin, which is not too bad at all, and it's definitely a little higher than the sector median. Now, just for a little bit of fun, I want to take a look at their total return over the past 1, 3, and 5-year marks. Now, total return does include dividends being reinvested back into the company, so we can see that CAT is at number 1 at basically 80%, Microsoft number 2 at 50%, Waste Management at 29%, C&I at 12.54%, and John Deere at 11.9% increase. Funny enough, CAT is actually down in the past 3 years compared to its 1 year with a total return of only 73%, and Microsoft beats it out at 75%, so it just barely squeaks that win. In third is Waste Management at 65%, and just like before, Canadian National Railway and John Deere are both at 15.49% and 14% respectively. And now for the 5-year time frame, what really cements Microsoft as the king here, it's up 272% in the past 5 years. CAT is in second, up 200%, with John Deere following it pretty closely, up 164%. Following that, we do have Waste Management at 120% return, and Canadian National Railway does come in last at 57%. As always, that does bring us to the end of today's video. If you guys did enjoy today's video, definitely subscribe to the channel. I post weekly investing videos, and if you haven't watched my latest video where I go over all my dividend income that I received in the month of March, definitely check it out right here. If you are interested in seeing my current thoughts about Tesla and my personal investment into the company, check it out right here. Thanks again for watching, and I will see you in the next one.